Hello and welcome to the weekly wrap video. It's been a tale of two risk events this week, the ECB rate decision and of course the non-farm payrolls. I'll start off chronologically on Thursday. Saw the ECB cutting all three of their major rates, and for the first time in the ECB's history they'll have a negative deposit rate. That's a minus 0.1%. The main referee rate was also cut to historic lows of 0.15%, and the marginal lending rate cut down to 0.4%, giving a symmetrical corridor for the ECB for the first time since last November. But the real focus was on the press conference, where ECB's Draghi presented a series of further tools to be conducted by the ECB in order to stem any deflationary pressure. So the first of which being a new type of long-term refinancing operation. That's a targeted LTRO. This is to take place over 4 years, so a 1 year longer maturity than the last LTROs, which were conducted in 2012. But no, these are targeted and are somewhat similar to the Bank of England's funding for lending scheme that we saw used not just last year but the year prior to that. So that's funds are only lent to these banks as long as they are earmarked for specific lending activities. So ECB's Draghi hopes that this will inject some credit into particularly those southern European states, which do continue to be marred by very high interest rates for small to medium-sized enterprises. In terms of the total quantity of these loans, which are due to be dispersed in September and December of this year, that's to the tune of around 400 billion euros, which is actually slightly smaller than those 3-year LTROs, where they lent out just over €1 trillion in unbridled cash to Eurozone banks. Secondly, they are to end the sterilisation of their securities market programme that they conducted a couple of years back. That's to inject around 140 to 150 billion euros into the Eurozone money markets, so also increasing the slosh of cash around the Eurozone and hopefully providing some inflationary pressure. They did also say they are accelerating the preparedness of ABS purchases, but first of all they really had to regulate these markets to make asset-backed securities very transparent as opposed to the opaque market that does currently exist. So in order for this to take place, there's still quite a lot of hurdles that have to be jumped by the ECB, so outright QE and asset purchases are actually relatively further down the line, possibly in the last quarter of 2014, if not the early months of 2015. In terms of the market moves off these ECB rate decisions, it's worth noting the euro is actually pretty much flat on the week, with much of these moves being priced in. That's despite the volatility we of course observed in the wake of the rate decisions themselves. So heading towards Friday's close, euro dollar is pretty much in line with the levels seen on Monday's open. One final thing worth noting, of course, is the extension of full allotment at the ECB, so that's a continued use of those short-term MROs and the 3-month LTROs, but they are pretty due course now. So we'll see how analysts do continue to digest these ECB policy tools that have been enacted. Don't have another inflation reading out of the ECB for quite some while now, so look out to see just how these impacts are having on Eurozone inflation expectations in due course. Then moving on to the change in non-farm payrolls, this reading was actually pretty boring, to be perfectly honest, with a 217,000 reading against expectations of 215,000. The unemployment rate was unchanged at 6.3% against analysts' forecast of a slight uptick to 6.4%. The participation rate also unchanged and still close to those multi-decade lows though, down at 62.8%. In terms of the markets though, they actually did see a bit of a reaction, possibly just slightly relieved we didn't see a worse than expected number, with US stocks moving to fresh all-time highs well ahead of Friday's close. So that's with the E-mini S&P just continuing to broach those levels, heading through around the lunchtime point of Friday's US session. In terms of risk events, next week it goes relatively quiet on the central bank front, but we're more than likely to see further ECB speakers to also have the UK jobs report that is keeping the Bank of England on hold at the moment, as was the case yesterday, with the historic bank rate down at 0.5%. But of course we're bringing you all of next week's releases as soon as they hit the wires, as well as any other relevant commentary to your trading. But in the meantime, that's all from me. Make sure you have a fantastic weekend.